Hi everyone, welcome to today's video. So on today's video, I'm going to help you break down the topic around gold investing in the year 2023. I will show you all the facts, figures, help you understand the fundamentals through this video. By the end of it, you will have a very clear understanding where gold should fit into your portfolio. Very quick look at this graph, and what you would notice is that from the year 2019, and if you consider this particular point here, that this is 2019, the gold prices were trading at INR 3000 rupees per gram. If you check the gold prices now, and you can easily do it by Googling gold prices as of today, you will see that the gold price is somewhere around 6,200 levels as of today. So within a span of 4 years, gold has given 100% returns. Now, if you compare this example to equity returns or stock returns of the entire stock market in India, what you will notice is that for the last 1.5 years, stock market in India or even across the globe has given close to 0% return. So here is the Nifty 50 chart, which represents the entire stock market sentiments and acts as a barometer. So what you will notice is that the stock market was somewhere around 17,800 in September of 2021. Right now, it is at 18,200 after 1.5 years of return. So close to 0% return on equities and almost 100% return on gold if you consider this short-term performance. Natural question comes that, what's the point of even investing in the stock market? So much jig is there. Our heart rate goes up and down. Our BP goes up and down by tracking the stock market. Gold is a safe instrument. SGB mein kar diya, sovereign gold bond mein if we go and invest, there is additional return of 2 to 3%. It's backed by the government. So why even bother about investing in the equity market? So let's decode this entire topic, and whether you are making money through gold investing, whether you are making money through stock investing, you will still have to pay your taxes. So from that perspective, check our sponsors for today, which is taxbuddy.com. It's a wonderful online tax filing platform. I'm sure that you're aware that the tax filing season is well underway. Now, due to several announcements made in the budget regarding old tax regime, new tax regime, there is a lot of confusion that is getting on that which tax regime you should pick. So filing your taxes is becoming a little bit complex. You probably won't even think of filing your taxes until July, but TaxBuddy has agreed to provide a massive 40% discount to my audiences. But this discount is only up until 22nd of May. So file your ITR before 22nd May using the link in the description and comment box. So with that said, let us begin our topic. And first and foremost, let us truly understand the concept of gold returns versus equity returns in a more fundamental manner. So just a while back, I had shown you this chart that if you consider gold returns from 2019, and this shows the returns till 2021. And as of now, the gold prices are roughly 6,200 per gram. So if you consider the story from here, you will see that पिछले 4 सालों में, in the last 4 years, the gold has given 100% returns. And this is what a lot of gold-based organizations that want you to put your money in gold are showing you. But understand the story further. For example, when was this price last existing? So you could argue that this price had existed back in 2013 also. That back in 2013, gold had peaked to 3,000 rupees per gram levels. And if you consider now the last 10 years returns of gold, it comes out to be a humbling less than 10%, because aap CAGR karoge, and if you do the CAGR analysis, then it will come out to be less than 10%. So yes, if you consider like last 4-year returns, okay, brilliant, 100% returns, but last 10 years has been less than 10%. So this is the first key point regarding returns that you need to understand, that you need to consider the horizon of returns. Many people make the argument that, okay, gold, brilliant asset, go and invest. Look at the last 4-year performance, and then you will get convinced that, yaar, brilliant. It's like an asset that you need to have. On the flip side, if you consider slightly longer term, you will get a different story. So don't get swayed by either of these arguments. Understand that when you're putting your money, whether in gold, equities, bonds, whatever asset you want to put your money on, you need to consider your time horizon more holistically. So with that said, let me give you a slightly more broader viewpoint and show you 2-3 more data points. So if you consider the last 50-year history of gold, and here I am considering the world prices and comparing it to the US data. The reason there is that the data in the US or market data from the US is slightly more cleaner, and the same trend will be represented in India. So what you will notice is that if you consider the last 50-year returns, and this captures 2022 2 also, then it is very simple that US stocks have given roughly 10.21%. In India, if you consider Nifty and calculate the last 20-year CAGR, it will come out to be roughly 12 to 13%, right? So it will be higher. Why is that? Because Indian currency, INR, it depreciates. So net in arbitrage terms, it comes out to be similar. On the flip side, if you consider commodities, like commodities means जैसे wheat हो गया, coal हो गया, petrol हो गया, all these are commodities. So here the returns is 8.3%. Gold has given 7.78%. So please compare this 10.21 with 7.78% as the last 50-year history. This is what the long-term data tells us. Let's go even further. Let's analyze trends within this long term. So for this, let me take you to this particular chart and I will put the links in the description box. You yourself can go and check it out. And this does a comparative analysis of investing in the markets, stocks versus gold. Okay, so this becomes even more interesting and there are 2-3 trends that I would like to outline that will help you cultivate a fundamental understanding about this topic. So what you would notice is that this orange line indicates gold returns, that if you consider, for example, this point, 1983, gold and equities used to work almost similarly. There used to be somewhat of an inverse relationship between the two, but the amount of returns both these asset classes used to give was somewhat similar. Then what happened after 1980s? Well, the thing called as money printing or depegging of gold as the standard currency happened, that the world moved away from gold standard and it moved to fiat standard as we see today. So any government has the power of printing as much money as they like, and the US government has started printing like crazy. So because of which one could argue that the stock price returns after 1980, so this is a chart, there has been a very clear divergence that the stock prices went up like crazy, but the gold prices somewhat flatlined in this entire zone. So when did this narrative change? So let me highlight this with a separate color, that this narrative started changing after 2008 onwards. That there was a sudden spike in the gold prices after 2008 and all the way till 2016-17. And then it flatlined again. And then again, it started rising somewhere around 2019 onwards. So 3 specific zones. This is zone number 1, right? Where we spoke about the fact that, okay, depegging of gold. This is zone number 2 post 2008 all the way till 2016-17, and this is zone number 3 after 2019. So there are brief periods when gold has given very strong returns. But on the flip side, if you compare the returns of stocks over a long time horizon, especially after 1980, you will see a very secular bull trend. Yes, of course, the market has corrected. For example, it has corrected here, here, here. But long term, if you simply eyeball this chart, you will get a very clear understanding that investing in equity has been a bigger wealth generator compared to investing in gold. So with that said, let me help you further break down this topic and help you understand this entire concept of investing in gold more fundamentally. Now, this is a very good summary of what investing in gold is like. And if you don't have a lot of time, just read through this summary. It will give you a lot of understanding. So for example, gold has been considered a store of value. I will explain what store of value means. Over the long term, however, both stocks and bonds have beaten and outperformed price increase in gold. This we have seen from a long-term perspective. Over certain short span of times, again, I had explained you 3 phases where gold has done fairly well, and I will explain you the reason behind that also. But it is true that there will be some periods or brief periods in history when gold will do exceptionally well. And right now we are in one such period. Then the gold tend to rise during periods of high inflation and geopolitical uncertainty. This is again a very important point and I will break it down. So if you understand these 3-4 points and absorb it, you will have a much better fundamental understanding as to when you should be buying gold and when you should be selling gold. So let me further help you consolidate these points. So gold prices go up because of 3 specific reasons. One is that if there is increased risk in the world, then people flock towards a safer asset or fixed supply assets like gold. Now, this has been the case over the last 1.5-2 years because there has been Russia-Ukraine war. There has been a lot of problems at a world level. COVID act as a destabilizer for the entire world, and people generally saw, more specifically investors really saw that, you know what, risk has gone up in the world. So as a result, 2 things happened. One is that there was a spike in gold prices, that brief period that we were earlier speaking about. And second key thing was that even currencies like US dollar got strengthened. Because think about it this way, that people usually say that, you know what, the money printing zyada ho jayegi, when more money is printed, then gold should go up, this, that. No. It's the search for safer assets that happens due to the increasing riskiness in the world. So safer assets, one could argue, would be something like gold. Safer asset could also be something like USD. So therefore, USD has strengthened compared to a lot of other currencies. But yes, I hope you got the first picture that, okay, why is it that the gold prices go up? Because the risk in the world has gone up. And that has been the case for the last 1.5 to 2 years. Second key case is that yes, inflation does impact the prices of gold. Why is that the case? Because see, if let's say there are $100 trillion that are flowing on in the economy, now suddenly the US decides that we are going to double the money supply, and they almost increase the money supply by a lot over the last couple of years. So what would people think? That people would think, yeah, you know what, I was having a lot of this paper money. Now government is printing more and more. They are just devaluing, because whenever there is more of something, it's get devalued. Now this is a concept that I have spoken quite extensively on some of my other videos, so I will not bring it up again, but I hope you got the picture that this is what leads to more inflation. And as a result, people look for assets that are fixed supply assets. Now chemistry tells us and history tells us total new gold that is getting added to the supply, you can't escalate that by more than 2 to 3%, because that is the rate at which the gold can be excavated, processed, refined. So it becomes somewhat of a limited supply asset. And whenever there is more money supply in the world, the price of the gold rises. Now this has happened in 2008, and therefore I showed you the graph. I'll point it to you again, that was a time when gold prices spiked. It again spiked after 2020 quite aggressively. Why? Because these were very important quantitative easing or money printing phases in the world. Now third, and more interestingly, that many a times there are countries that demand gold. Now we might assume that the most of the gold is sold to people who are craving for jewelries. That is not really the case. The biggest buyer of gold are actually the governments. Now, what has happened after 2021 is that because of Russia-Ukraine crisis, the US imposed sanctions on Russia. They said that, you know what, whatever money you have in USD, you can't trade. We are kicking you off of our financial system. Russia said, cool, do it, not a problem. We will peg our currency to gold. They started buying a lot of gold. So this is called as increasing of the sovereign demand of gold. These type of phases rarely happen in the economy, and the current growth rate that is being witnessed in gold also has a lot to do with countries like China and Russia trying to move to gold as their currency. I don't know if they will be able to do that or no, but what they are simply doing is that they are stockpiling gold and cutting off a lot of US dollar. So that has led to an exponential growth phase for gold over the last 1.5 years. So now if you are considering buying gold in 2023, when the gold prices are already trading in India at roughly 60 to 100 rupees per gram, you need to ask yourself a question that, hey, are these things, whatever I've spoken about, are they going to continue to exhibit from now onwards? For example, are the governments going to print or have spurge in terms of money printing like crazy going from this point? That's one. Second, do you see more risk in the world as of now? Third, do you see countries like China and Russia increasing their gold buying demands very, very quickly from this point? To me, the answers look like a no. So which brings us to the third section of the video, where I will give you a very quick overview of investing in gold versus investing in equity. So this will help you further refine this topic and accordingly build positions. So many of you would be operating with the belief that buying something like sovereign gold bond is a great investment option right now. Why is that the case? And in case you don't know much about sovereign gold bond, I have done separate videos. I will link them in the description and comment box. But very quick understanding is that there are two ways in which you can buy gold. In fact, there are multiple ways, but two primary ways. One is that you go and buy physical gold. For example, you buy gold coins, you buy gold bars, then you go and stock them in your locker or wherever it is. Second is that you buy gold in paper format, right? So what are these paper format? For example, sovereign gold bond is a type of a bond that is issued by the government. So are you getting physical access to gold? The answer is no. But the government tells you that, you know what, trust us and buy these bonds from us, give us your 1000 rupee, and in theory or on paper, you have like 1000 rupee worth of gold. Now, the advantage there is that the government says that we will give you 2 to 3% more market returns compared to whatever the appreciation of gold is. Now, if you do a very quick comparison of sovereign gold bond what is happening there is that you are typically not making more than 9 to 10%, but these returns definitely do depend on the overall market returns on gold. So to cut the long story short, what is happening here is that whether you buy gold in physical format or whether you buy gold in paper format, what is it that the gold return is dependent on? Well, it is dependent on the underlying return of the gold as a commodity. And we had discussed this in the previous sections that if the overall gold prices go up, then probably sovereign gold bond becomes a wonderful investment. But if the gold prices in absolute terms are not going up, then whether you hold gold in physical format or in paper format, you will not make money or much money on gold. So this is part one of the equation. Second part of the equation is that, see, if you have black money and if you are buying gold bars, gold coins, etc., that is okay, because gold typically does not go down in value. On the flip side, if you are holding this black money, then every year the INR depreciates compared to US dollar by 4-5%. So INR keeps on losing its value. So if you have black money, then you don't have too many options. I'm not promoting black money economy. I'm just simply discussing the fundamental concept with that. On the flip side, if you have white money, right? With white money only, you can go and buy something like sovereign gold bond. Now comes the natural question that, bhai, should you be buying sovereign gold bond? Now here, if your answer is that, see, going forward in the future, gold is going to beat something like stocks in terms of returns, then you can go and invest in gold. I get a lot of counter questions that, okay, should you not hedge your portfolio by buying gold, this, that? No, please understand the concept of paper money here. Now, whether you are choosing to keep your money in HUL stock or Nifty 50 or SGB, I'm talking about SGB, not physical gold. All these three options are paper money options. Now, very quickly explaining you the concept of paper money, there are two types of things in the world. One is physical goods. If you are buying physical gold, if you are buying physical real estate, if you are buying real commodities, these are physical goods. On the flip side, everything else is like paper money. If you are investing in the stock market, it's paper money. If you are investing in SGB, it's paper money. Interestingly, sovereign gold bond are not backed by gold. It's not like as if government is keeping 1 kilo of gold in their locker and issuing those 1 kilo worth of bonds. No, they are not doing that. In case the government defaults, your SGB goes down with it. And that is the difference between paper assets and physical assets. That physical assets do not need government backing. If you have a land and if you hold it, then that's a real asset that you're owning. But on the flip side, if you're owning Nifty 50 and if the Indian government decides to devalue its currency, then what would happen? That if they decide that 100 rupees ka worth will become like 50 rupees of worth after a few years, how this will happen? This will happen if the government decides to print a lot of money. What happens to your Nifty 50 investment or any kind of paper investments? Well, it goes down in value by 50%. Does that happen to land that you own? The short answer is no. Does that happen to physical gold that you're owning? The short answer is no. In my opinion, rather than owning a sovereign gold bond, you are much better off investing in something like Nifty 50. Why is that the case? Because Nifty 50 is also a representation of paper money. We have seen from the previous charts that the returns on equities are much higher from a long-term perspective compared to gold returns. And even if you add up that 2 to 3% return that SGBs are giving, still the equity market on Nifty 50 as a collective matrix is going to beat gold returns going forward in the future. Now, why is that the case? Because Nifty 50 is a barometer for our economy. Whenever we say that India's GDP is going up or India will become $10 trillion economy, what does that mean? It means that the companies collectively in India or individuals collectively in India are generating that level of output. It cannot happen that Nifty will stay at 18,000, 19,000 and India will become a $10 trillion economy or India's economy will go 3x, 4x. It can't happen. If India's GDP has to go to $10 trillion or $15 trillion or $20 trillion, then Nifty 50 will at least do an equal amount of growth. So to cut the long story short, if you want to bet on the government and on that paper money, then probably the best matrix is to go to the entire stock market. On the flip side, if your viewpoint is that, you know what, I will probably want some safety कि कल को कुछ हो गया, government prints too much money, defaults on its debt वगैरह वगैरह, or I just simply want to preserve my wealth, buy land or buy gold because these are fixed supply assets. I can also speak about Bitcoin, but unnecessarily there is like a lot of heat against like cryptocurrencies. So I'm not even touching that topic, but from time to time, I give a lot of commentary on member community tab regarding buying stocks, selling stocks, which assets I'm investing, which assets I'm selling. So all this information, including cryptocurrency, is given on that member community tab. So you can go and check it out. Now, final point that you need to study here is the market cycle game. For example, from the year 2019 to 2023, Gold was in an upswing, so that was an upward part of the market cycle. What about stock? The stock was in a downswing, so to say. Over the last 1.5 years, stocks have given 0% returns. So do you think that right now is the overall stock market overvalued or undervalued? And what do you think about gold? That is it overvalued or undervalued? Use basic common sense and you yourself will be able to see the answer. Now comes the final interesting point, and there is a tweet also that I've done on this topic, which outlines the recent changes that have been done by the Indian government. For example, if you're trying to invest abroad, or if you're traveling abroad, you have to pay 20% TCS. So government does not want you to send your money outside India. Why? Because it devalues INR. Second key thing, you must have noticed that debt mutual funds these days, they have been brought at par to FDs. Now, whether you do FD investment, whether you do debt mutual fund investment, after tax returns are exactly the same. Indexation benefits have been taken away from debt mutual fund. So government does not want you to put your money in debt mutual funds. On top of that, if you're looking to buy gold, physical gold, or if you're looking to buy land, there are massive taxations on that. So either put your money in paper assets like sovereign gold bonds, REITs का आपने सुना होगा, that like so many people podcast कर लो, ये कर लो, वो कर लो, right? People are just talking about REITs like there is like no tomorrow and it's the best asset in the world. Honestly, there is no difference in this paper money game, right? The second option for you is to buy physical assets. So if you're buying physical assets, please buy physical assets. For example, gold, according to me, is a physical asset. If you're going in the paper currency side, equity still is the number one option for you. On top of that, in the year 2023, the equities have not given any returns for the last 1.5 to 2 years. So it means that compared to gold, it is somewhat an undervalued asset. Whatever decisions you are making, you have to make it in accordance with your portfolio. So as a next step, please consider watching this particular video. I have discussed how I am designing my portfolio, and it would allow you to do the same and pick the right type of bets that fits with your goals. So I hope you enjoyed this video. If you did, do press the like button, and I will see you very soon.